Bismillahirrahmanirrahim. This is the first video on incremental analysis. Business decisions consider both financial and non-financial information. Financial information is related with revenues and costs and their impact on companies' profitability. Non-financial information is related to decisions related to employee turnover, environment, image of the company, etc. However, in this video, we will only talk about the financial information that is relevant to the managerial decisions. In this video, we will describe the concept of incremental analysis. Then we will identify the relevant cost in accepting an order at a special price and make or buy decision. While in the next video, we will explain how to determine whether to sell or process materials further. We will talk about costs to be considered in repairing, retaining, or replacing equipment. And finally, how to decide whether to eliminate an unprofitable segment or product or not. Please like, share, and subscribe my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accounting@gmail.com. We hope that this video help students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope this video helps ACCA, AICPA, CPA, and CPA aspirants. We also hope that this video helps fresh graduates who have joined the companies and want to refresh their learning of incremental analysis. Let us start with the concept of incremental analysis approach now. Incremental analysis is a decision-making technique used in business to determine the true cost difference between alternatives. It is also called the relevant cost approach, marginal analysis, or differential analysis. Incremental analysis disregards any sunk cost. Let us see how incremental analysis helps in management decision making. We have alternative A and alternative B. The net income column shows the difference between the alternatives A and alternative B. The incremental revenue will be 15,000 less if the company accepts alternative B. However, there will be a 20,000 incremental cost savings if they accept alternative B. So alternative B will produce 5,000 more net income than alternative A. Let us look into the three important concepts used in incremental analysis. First one is the relevant cost. Incremental analysis is a decision-making tool in which the relevant costs and revenues of one alternative are compared to the relevant cost and revenues of another alternative. Relevant cost may be defined as those future costs that are different between alternatives. Opportunity cost is the next. An incremental analysis considers opportunity cost, the missed opportunity when choosing one alternative over another to make sure the company pursues the most favorable option. Finally, non-relevant sunk costs are expenses already incurred because the sunk cost will remain regardless of any decision. These expenses are not included in incremental analysis. Let us see how incremental analysis works. Interestingly, incremental analysis sometimes involves changes that at first glance might seem contrary to your intuition. For example, sometimes variable costs do not change under the alternative courses of actions, while fixed costs do change. For example, direct labor is normally considered as a variable cost, but it will not be considered as incremental if the two alternative requires the same amount of direct labor. Next, think of rent expense that is normally a fixed cost, but it will be considered as incremental cost if the decision is to be made whether to continue the occupancy of a building or to purchase or lease a new building. Let us solve some exercises on incremental analysis. Bogart Company is considering two alternatives. Alternative A will have revenue of 160,000 and cost of 100,000. Alternative B will have revenues of 180,000 and cost of 125,000. So the net income in case of alternative A will be 60,000, while for alternative B it will be 55,000. The revenues will increase by 20,000 if we accept alternative B, and the cost will also increase by 25,000 if we opt for alternative B. So there will be a net loss of 5,000 if we select alternative B. So alternative A is better than alternative B. Let us look into types of incremental analysis. I have already put this in an Excel sheet in case if you find my writing difficult to read. And now let us look into the types of incremental analysis. As already stated at the beginning of this video, we will identify the relevant cost in accepting an order at a special price and make or buy decision, while in the next video we will explain how to determine whether to sell or process materials further, costs to be considered in repairing, retaining or replacing equipment, and deciding whether to eliminate an unprofitable segment or product. Let us now talk about accepting an order at a special price. Incremental analysis helps companies decide whether or not to accept a special order. This special order is typically lower than its normal selling price. Incremental analysis also assists with allocating limited resources to several product lines to ensure a scarce asset is used to maximum benefit. Let us see how this happens by solving an illustration. Sunbelt Company produces 100,000 smoothie blenders per month, which is 80% of plant capacity. Variable manufacturing costs are 8 per unit. Fixed manufacturing costs are 400,000 or 4 per unit. The blenders are normally sold directly to retailers at 20 each. Sunbelt has an offer from Kensington Company, a foreign wholesaler, to purchase an additional 2000 blenders at 11 per unit. So, if the management makes decision on the basis of the total cost per unit, so variable cost per unit is 8 and fixed cost per unit is 4, so the total cost is 12 and the offered price is 11, so the company will be making a loss of 1 per unit. However, since the units can be produced with the existing plant capacity, let us see what happens. Now, if we reject the order, there will be no impact as far as the revenue, cost or net income is concerned. But if we accept the order, our revenue will increase by 2000 times 11, that is 22,000. We are not going to consider the fixed cost because it is a sunk cost, and it says over here that acceptance of the offer would not affect normal sales of the product, and the additional units can be manufactured without increasing the plant capacity. So we will intentionally ignore the fixed cost, and the variable cost for this special order will be 16,000. So the net income is going to be 6,000. Now you can see that our revenue increases by 22,000. The cost will increase by 16,000 and the net income will increase by 6,000. So Sunbelt will increase its net income by 6,000 by accepting this offer. Let us look into one more illustration. And before that, let me tell you, I have put the same illustration in an Excel sheet in case you find difficult to read my handwriting. Cobb Company incurs cost of 28 per unit, 18 variable cost and 10 fixed cost to make a product that normally sells for 42. A foreign wholesaler offers to buy 5,000 units at 25 each. Cobb will incur additional shipping cost of $1 per unit. Compute the increase or decrease in net income Cobb will realize by accepting the special order, assuming Cobb has excess operating capacity. That means we are not going to incur any additional fixed cost should the company accept the special order. Now, again, if we reject this order, there will be no impact on revenue, cost or net income. If we accept the order 5,000 units times 25, our revenue will increase by 125,000, while the cost, we will be considering only the variable cost 18 plus 1 per unit of shipping cost, that makes 19. 19 times 5,000 is 95,000. So the net income will be 30,000. So the revenue, if we accept the order, will increase by 125,000, cost will increase by 95,000 and the net income will increase by 30,000. So the company should accept this order. I have put the same illustration in an Excel sheet over here as well in case you find my writing difficult to read. Let us look into one more illustration. At James Company, it cost 30 per unit 20 variable and 10 fixed to make a product at full capacity that normally sells for 45. A foreign wholesaler offers to buy 3000 units at 25 each. James will incur special shipping cost of 2 per unit. Assuming that James has excess operating capacity, indicate the net income or loss James would realize by accepting the special order. Now, in this case, again, there will be no impact as far as revenues is concerned or the variable cost or the shipping cost is concerned if we reject the order, and then there will be no impact on net income. However, if we accept the order, it is we are going to have 3000 units at a price of 25 each, that makes 75,000. The variable cost will be 20 times 3000, that makes 60,000. The variable manufacturing cost will increase by 60,000, and there will be an additional shipping cost of 2, that makes 6,000. So the net income will be 9,000 if we accept the order. So the revenue, if we accept the order, will increase by 75,000. Variable manufacturing cost will increase by 60,000. Shipping cost will increase by 6,000, and the net income will increase by 9,000. So the company should accept this special order. Again, I have put this solution in this Excel sheet in case you find difficult to read my handwriting. Let us look into another illustration. And Leno Company manufactures toasters. For the first 8 months of 2014, the company reported the following operating results while operating at 75% of plant capacity. They are selling 350,000 units for 4,375,000. Cost of goods sold is 2,600,000. Gross profit is 1,775,000. Operating expenses are 840,000 and net income is 935. Cost of goods sold was 70% variable and 30% fixed. Operating expenses were 75% variable and 25% fixed. In September, Leno Company received a special order of 15,000 toasters at 7.6 each from Centro Company. Acceptance of the order would result in an additional 3,000 of shipping cost, but no increase in fixed operating expenses. Prepare an incremental analysis. So again, if we reject the order, there is no impact on revenue or cost of goods sold or operating income. So there will be no impact on net income as well. Now, as far as revenue is concerned, it is 15,000 toasters at the price of 7.6. That makes 114,000. So the revenue will increase by 114,000 if we accept the order. Let me explain you how to get the variable cost of goods sold. First of all, before we record the other information over here. Now the variable cost of goods sold is 2,600,000. And from this, 70% is variable. So 70% of 2,600,000 is 1,820,000. So the variable cost per unit will be 1,820,000 divided by the number of units, that is 350,000. So this will be 5.2. So the variable cost for the special order, we are receiving an order of 15,000. So 15,000 times 5.2, that will give us 78,000. So the cost of goods sold for this special order will be 78,000, and our cost of goods sold will increase by 78,000. Next we have operating expenses, and variable operating expenses are the total operating expenses are 840, and from these 840, 75% are variable. So this is equal to 630,000, and we have the number of units 630,000, the number of units is 350,000. So the cost per unit will be 1.8. So variable expenses for the special order will be 15,000 units times 1.8, that is 27,000. And we have an additional 3,000 of shipping cost, so that is going to be 3,000 as well, that makes 30,000. So the operating expenses will be 30,000, and they are also going to increase by 30,000. So we have the total cost as 108,000, and we have the revenue of 114. So our income is going to increase by 6,000. So we should, because our profit is increasing by 6,000, we should accept the order, as it is increasing our expenses by 6,000. Once again, I have put this illustration in this Excel sheet in case if you find difficult to read my handwriting. And let us now look into one more type of incremental analysis, that is make or buy decision. A make or buy decision is an act of choosing between manufacturing a product in-house or purchasing it from an external supplier. Make or buy decisions, like outsourcing decisions, makes a comparison of the costs and advantages of producing in-house versus buying it elsewhere. Let us look into an example. Baron Company incurs a total of 225,000 annual cost in producing 25,000 ignition switches for motor scooters. These costs include direct material 50,000, direct labor 75,000, variable manufacturing overhead 40,000, fixed manufacturing overhead 60,000, and the cost per unit is 9. Now, instead of making its own switches, Baron Company might purchase the ignition switches at a price of 8 per unit. So if you look on the face of it, at first glance it appears that management should purchase the ignition switches for 8 rather than make them at a price of or at a cost of 9. Let us apply the concept of incremental analysis in make or buy decision. Now once again, if we make the decision, if we make the product, Then direct material cost will be 50,000. Direct labor is 75. 50,000, 75,000. Variable manufacturing overhead is 40,000 and fixed overhead is 60,000. We are not purchasing, we are making the product in-house, so the total annual cost will be 225,000. Now, if we buy this product, obviously there will be no direct material, there will be no direct labor, there will be no variable manufacturing overhead. And what they say is, if we are going to buy all of Baron's variable cost, but only 10,000 of its fixed manufacturing cost will be eliminated. That means 50,000 of fixed cost will still be there. And the purchase price will be 200,000. So the cost is, if we buy, is 250,000. So actually our cost is going to increase by 25,000. And let us see here as well, you see our direct material is going to decrease by 50,000 if we buy the product. Direct labor is going to decrease by 75,000. Variable manufacturing overhead will decrease by 40,000. Direct fixed cost or fixed manufacturing overhead is going to decrease by 10,000, although we are going to purchase it for 200,000, so the purchase cost is going to increase. However, you can see that our cost is increasing by 25,000 if we are going to buy this product. So this analysis indicates that the Baron company would incur 25,000 of additional cost if they are going to buy the ignition switches rather than they make them. Therefore, Baron company should continue to make the ignition switches even though the total manufacturing cost is $1 higher per unit than the purchase price. The primary cause of this result is that even if the company purchases the ignition switches, it will still have a fixed cost of 50,000 to be absorbed. Yet an important cost to be considered in make or buy decisions is the opportunity cost, and let us talk about it in the next slide. Rather, I have again put this in an Excel sheet in case you find my writing difficult to read. So let us now talk about the opportunity cost. So opportunity cost is an economic term that refers to the value of what you have to give up in order for choosing something else. Another consideration in a make or buy decisions is whether the firm has alternative uses for its facilities if it should decide to buy the product from an outside supplier. Buying the product from a supplier may make manufacturing and or warehouse space available for an alternative profitable use. The potential profits are opportunity costs that must be added to the cost of manufacturing the product in-house. If the company can use the facilities to earn additional revenue, it may be better to buy from outside rather than lose this revenue. Losing revenue represents an opportunity cost, that is, the segment margin foregone when one alternative is chosen over another. Let us look into an example. Baron Company incurs a total of 225,000 annual cost in producing 25,000 ignition switches for monitor scooters. These costs include direct material 50. We have all the cost as we have done in the previous illustration. So we have the same information. We just clip in these values, 50,000 for direct labor, direct material, direct labor will be 75. variable manufacturing overhead will be 40, fixed manufacturing overhead will be 60, there will be no purchase price, and the total cost will be 225,000. If we buy the product, obviously there will be no direct material, there will be no direct labor, there will be no variable manufacturing overhead. Fixed manufacturing overhead will be 50,000, and we are going to pay to buy this now, so the cost will be, purchase price will be 200,000, so that is makes 250. So if we buy, we are going to pay an additional 225,000 of cost. Although there will be a decrease in direct material by 5,000, there will be 50,000, sorry, 75,000 of variable direct labor is going to decrease. Variable manufacturing overhead will decrease by 40,000. The fixed cost is going to decrease by 10,000, and the purchase price will increase our cost by 200,000. So now we bring in the concept of opportunity cost. Assume that through buying the switches, Baron Company can use the released productive capacity to generate additional income of 38,000 from producing a different product. This lost income is an additional cost. So recall that buying the product from the supplier may create manufacturing space available for an alternative profitable use, and this potential profit are opportunity cost that must be added to the cost of manufacturing the product in-house. So the opportunity cost will be 38,000, and now the total cost for in-house is going to be 263,000. There will be no opportunity cost if we are going to buy, and the total cost will be 250,000. And now you can see that the company total cost is going to decrease by 13,000. So the opportunity cost will increase, is going to decrease our our cost will decrease by 13,000, and if the released product capacity can generate an additional income of 38,000, it means that the cost will decrease by 38,000, thereby increasing the profits by 13,000. 25 minus plus 13, you can say, or 38 minus 25 will give you 13,000, and now it is profitable to buy the ignition switches, as the company's income will increase by 13,000. Let us look into one more example or one more illustration, and before that I can just remind you that I have again put this solution in an Excel sheet to make it convenient for you to read if you find difficult to read my handwriting. Okay. Now, Juanita Company must decide whether to make or buy some of its components for the appliances it produces. The cost of producing 166,000 electrical cords for its appliances are as follows: direct material, direct labor, variable overhead, fixed overhead. And we have the same, except you see the cost per unit is 1. The company has an opportunity to buy the cord at 0.9 per unit. So on the face of it, it looks like it's better to buy the product because it is going to cost us $0.10 less. So if we are making the product, the direct material will be 90,000. Direct labor will be 20,000. Variable manufacturing overhead will be 32,000. Fixed manufacturing overhead are 24,000. There is no purchase price because we are making an in-house, and the total annual cost will be 166,000. If we buy the product, there will be no direct material, there will be no direct labor. Variable manufacturing overhead, there will be 0 again. The fixed manufacturing overhead, they say 1/4 of the fixed cost will be eliminated. That means 3/4 will still be there, and that is 18,000. And we are going to pay for purchasing, and that is going to be 149,400. So the total cost will be 167,400. So if we buy, we are going to pay more, and our cost will be more by 1,400. Although there will be a decrease in the direct material by 90,000, there will be a decrease in direct labor by 20,000. There will be a decrease in the variable manufacturing overhead by 32,000. We have already seen that there will be a decrease in the fixed cost by 6,000, and we are going to the cost of purchase will increase by 149,400. Now, so this analysis indicates that Juanita company will incur a 1,400 of additional cost if it buy the electrical cords rather than they make it. But then look over here, will your answer be different if the released productive capacity will generate additional income of 5,000? So if there is an additional income, that if you can, I would again repeat that if we are going to buy the product from a supplier, this may create manufacturing space available for an alternative profitable use, and this potential profits are opportunity cost that must be added to the cost of manufacturing the product in-house. So this 5,000 must be added for in-house production. So our cost will be actually 263,000, although there is no opportunity cost if we are buying. So the total cost still remains as, this will be 171, and this will be still the same 167,400. So because of this opportunity cost, if we buy, our cost will decrease by 5,000, and our total cost will thus decrease by 3,600 on. So we should go for buying the product if there is an opportunity cost of 5,000. Let us look into one more illustration. Rather, again, I have put this in an Excel sheet for your convenience, and you can see that the total cost is going to decrease by 3,600 if the opportunity cost of 5,000 is there. Let us look into one more illustration, or in Manzan Industries incurs unit cost of 8, 5 variable and 3 fixed in making a sub-assembly part for its finished product. A supplier offers to make 10,000 of the assembly part at 6 per unit. If the offer is accepted, Manzan will save all variable cost but no fixed cost. So we are going to have a variable cost of, if we are making, we have a variable cost of 50,000, and the fixed cost is for 30,000. So that makes 80,000. Sorry, there is no purchase price, so that makes 80,000 as our total cost. There is no variable. If we are buying, the variable cost will be 0, but fixed cost will still be there. And we are buying 10,000 units at a price of 6, that makes 60. So the total cost if we buy is going to be 90,000. So variable cost is going to decrease by 50,000 if we are going to buy the product. Fixed cost, there will be no change. Purchase price will increase the cost by 60. So the cost is going to increase by 10,000 if we are going to buy the product. So the decision should be to make the part in house. Let us look into one more illustration exercise, and again this is in an Excel sheet, and we go for one more exercise over here. And Jobs in corporation has recently started the manufacture of Robo, a three-wheeled robot that can scan a home for fires and gas leaks and then transmit this information to the mobile phone. The cost structure to manufacture 20,000 Robos is as follows. Direct material is 1 million. Direct labor is 800,000. Variable overhead is 120,000. Fixed overhead is 600,000. There is obviously no purchase price, so the total cost if we are making this product is 2,520,000. If we are going to buy this product, there will be, you can see that job is approaching which offers to make try for 115 or 2,300,000. So if they are going to buy, they are going to buy for 2,300,000. Using incremental analysis, determine whether job should accept this offer under each of the following independent assumptions. Assume that 405,000 of the fixed overhead cost can be reduced or avoided. That means the fixed cost if we buy will be 195. And there will be no direct material cost, no direct labor, no variable overhead. So our direct material cost will decrease by 1 million if we are buying the product. Direct labor is going to decrease by 800,000 if we are buying the product. Same for one variable overhead, it will decrease by 120, and the fixed overhead is going to decrease by 405,000, and obviously we have to pay 2,300,000. So if we buy, the total cost is 2,495,000. That means our cost is going to decrease by 25,000. Let me check it once more. 2,495. Yes, 25,000. Okay. Now assume that none of the fixed overhead can be reduced or avoided. So the offer should be accepted as net income will increase by 25,000 in case 1. Now in case 2, assume that none of the fixed overhead can be reduced. That means if we are making, obviously there is no change. 1 million for direct labor, 800 for 1 million for direct material, 800 for direct labor. Variable overhead will be 120, fixed overhead will be 600, and there is no purchase price, and the cost will be 2,925. While if we buy, there will be no direct material, no direct labor, no variable overhead. Fixed overhead will be the same, no variable overhead. Fixed overhead will be the same, there is no change. 600,000. Purchase price will be 2,300,000, so that makes 2,900,000. And now you see the direct material will decrease by 1 million if we buy. Direct labor will decrease by 800 if we buy. Variable overhead will decrease by 120,000. Fixed overhead will not change, and the purchase price, however, now you can see here, however, if the robots are purchased from T Incorporation, they can use the release productive resources to generate an additional income of 405,000. That means that there will be an additional cost of, so this should be added to the purchase if as an opportunity cost. 405,000, and now this will be 2925. So the purchase price is going to be 1,895,000, and now our profit will decrease by 25,000. So if in the second case, we should not go for the we should not go for buying the product. I have again put this information in an Excel sheet, and this completes the first part of incremental analysis. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Thank you so much and happy learning.